All right. Hello, everyone, and thank you all for joining us during the Lytham Partners Summer 2021 Investor Conference. My name is Robert Blum, Managing Partner of Lytham Partners. Up next, we have a panel discussion, which we hope you all find insightful, covering SPACs with two of the leading authorities on the topic, John Lipman and Mitch Nussbaum. John is an investment banker and investor with over 15 years experience advising growth companies, having completed over 125 offerings and advisory assignments for various clients. He is currently co-CEO of Roth CH Acquisition 3, a $115 million SPAC, chief operating officer and a board member of Roth CH Acquisition 2, a $115 million SPAC that went public in December 2020 and announced its intended merger with Reservoir Holdings, a leading independent music company, in April. He was also the chief operating officer and a board member of Roth CH Acquisition 1, a $77 million SPAC that merged with plastics recycler Pure Cycle Technologies, which now trades under the ticker PCT. Mitch is the vice chair of Loeb Loeb and serves as co-chair of the firm's capital markets and corporate department. His practice focuses on representing emerging growth companies and investment banks and IPOs of operating companies and SPACs, along with follow-on public offerings, shelf takedowns, registered direct placements, PIPEs, and other private placements. Mitch also regularly represents public companies regarding their SEC and NYSE or NASDAQ listing compliance, and has acted as outside general counsel to hundreds of private and public companies, as well as their officers and directors. According to IPO Vital Signs league tables, in most of the past 10 years, Mitch has been ranked as one of the top 5 attorneys in the country based on the number of public offerings he has completed on behalf of issuers or underwriters. And before I begin, for those not familiar, Lytham Partners is one of the country's leading investor relations firm. With more than 2 decades of corporate access experience, we've built one of the industry's most diverse and effective platforms for connecting small companies with high quality and focused institutional investors, while creating a framework of best practices in all aspects of investor relations. Today's panel is hopefully yet another example where we can bring value to multiple constituents. With that said, let's dive in. John, first to you. Let's start high level. For those not familiar with SPACs, can you provide a brief overview?
Yeah, the SPAC product is an alternative to an IPO. It's a vehicle that goes public. It's kind of almost the reverse of an IPO. It's a blank check vehicle that goes public on typically an exchange, New York Stock Exchange or NASDAQ or foreign exchange that lists, and the investors put up, IPO money. The money is going to sit in a trust account. Typically in the US, the IPOs are done at $10 a share, unless you're Bill Ackman, especially did one at 20. And the SPAC is created by a sponsor, usually a captain of industry. And that person or that team has specific deal flow, usually in certain verticals. And the idea is that they're going to go find a privately held company that is audit ready, public ready, and by effecting a merger with the public company with cash, the private company will be public. Think of it almost as a reverse merger. So an IPO of a business that has no business, the business sole purpose is to find a business that's private, to merge with it in a very elegant, quick, and easy way for a privately held company to skirt through doing the whole IPO process and just merge into a public entity. And that's what a SPAC is, a quicker, easier, faster way to do an IPO.
Perfect. And Mitch, maybe for a process that originated nearly 30 years ago, I think it is, why do you believe the popularity of SPACs has taken off, maybe let's say in the last 2 years? What were the drivers that led to the resurgence of this process that's been around for decades?
Yeah, no, a great question, Robert. I would say that there's probably been 2 or 3 tiers to get to where we are now. There was certainly 2020, which was a huge step up. There were 248 SPACs done in 2020. And I think the year before that, we did something like 60 something SPACs in 2019. So it went up about 4 times the number between 2019 and 2020. before, but you got to look at, there was one step up before 2018 and 2019, and then there was the 2020 step up. So let's start with the first step up, because before 2019, I will double check the numbers, but I think you were like at half of that amount in terms of the number of SPACs. So what we saw around 2018 was a lot of the private equity funds started getting involved, started looking at the SPAC structure and saying, you know what, maybe this is something that we should, get involved with as a complementary feature to our existing business. You see, they used to look at SPACs as, I don't know if the word competitive is the right word, because SPACs weren't large enough to be competitive at that point, but they looked at SPACs as being a very different business than what they were already in prior to 2018. Then in 2018, they started seeing, around then, 2017, 2018, they started saying, you know what, there's some features about the SPAC that we think is really, really interesting. There are actually deals that we could do that it eliminated some of their liquidity issues, because private equity was locked into these deals for, as much as 5 years at a time. They started looking at, they could go sponsor these vehicles and yet be liquid in these things. And it was really just diversifying their existing business. So they look at it as a diversification of their existing business as something that was completely different. And we saw a lot of big name private equity funds doing that in those 2 years. Now, when they did that, it obviously brought up the number of deals a bit. It certainly brought up the gross proceeds of the amount of money raised in SPACs, because they were doing the larger SPACs. But what it also did was it brought a lot of credibility to the product that we didn't have in this product before. We've had some big names come in and out of it over the course of years, but when the private equity funds came into this sort of en masse, it really stepped up the credibility of the product. And then that brings us to 2020. And when COVID started, this thing took off like a rocket ship. And there, I believe there are a few things at play that happened at the same time. I would say that what you have to look at is that the targets, when you got into COVID, a lot of these targets, fast-growing companies, not big revenuing companies, but really fast-growing companies, started looking at this SPAC and saying, I think this might be a good alternative for us than going to an IPO. And the reason why is because when we went to COVID, there was a concern from a lot of these target companies that, if I go public during a traditional underwriting, on this COVID situation, this is the beginning of COVID, right? And if you remember, it wasn't that long ago, but it feels like it's a long time ago. But when we first got into COVID, people were really, really concerned that the markets were going to fall right from under us, which they did initially, as we remember, in March of 2020. And so a lot of these companies were like, you know what, I don't know if I can get to market using a traditional IPO. I don't know if I'm going to be able to go out. This is not the time for me to go burn millions of dollars and spend a ton of time for me to go work on a traditional IPO and then find out that there's no market there, or find out that the underwriter is going to completely provide terms that weren't satisfactory. So, they said, well, let's look at the SPAC. And then there were a couple examples of SPACs that did well, like the DraftKings of the world, those type, Nickel at the time. We don't talk much about Nickel now, but at the time it was doing very well. And they said, look at these SPACs. These companies merged into their SPACs. They're trading great. They got a great valuation. And the other thing is that they were able to include their projections in these proxy statements. They were able to market their company off of these projections. So you had one company after the other saying, you know what, listen, maybe I should really start looking at these SPACs as an alternative for us here. I don't have to deal with all the uncertainty. All I have to do is sign a merger agreement with the SPAC. They're fully committed to the deal. So whatever happens during COVID here, I got a committed deal with I have a committed merger partner. I can negotiate my valuation. I'm not going to be subject to what the underwriter does later. All of the, and look at how these other deals are trading. And so that's sort of what precipitated this movement towards these SPAC mergers. And then once some of these SPAC mergers, once these targets started coming in, it was amazing to me how quickly these SPAC management teams picked up on that and said, listen, I got to go form my own SPAC. There's all of these companies lined up that wants to merge into this stuff. It's time to go, form my own. And then we saw a huge wave of managers get together and say, I'm going to go form my own SPAC. And then boom, we went to the 248 that we had for last year. And flipping to 2021, the first quarter, when it was another step up. We've done 311 SPACs up until yesterday, right? There was 331 SPACs up until yesterday, already exceeding as of, June 8th. As of June 8th of this year, 331 SPACs compared to the 248 from last year. Out of that 331, over 300 of them were done by the end of the first quarter of 2021. So a huge number was done, through March. We're seeing some of that, slow down a little bit. We're not seeing as many as we saw for the first 3 months of the year. We'll get into that, but that's sort of what we've been seeing over the last few years, and the phenomenon that became the SPAC phenomenon of late.
Perfect. Let's kind of start at the beginning of the process here a little bit, John. When raising money initially for the SPAC, what are some of the key components that these investors are looking for? Some say this is sort of a riskless type investment. Is it? Go into that in some detail if you could.
Short answer, yes. For the SPAC IPO investor, I'd say the risk is really the opportunity cost. Where else can I put my capital at that period of time? And so if you think about it, and Mitch has been around SPACs longer than I have, but typically today the usual SPAC has a $10 IPO. The sponsor and the team that create the SPAC have a certain amount of capital that they put into it to form the vehicle, hire lawyers like Mitch and IR firms like yours to help them through the process, accounting and audits, and there are expenses with doing an IPO, underwriting fees, and so we call that their risk capital and the shares that they buy for creating the vehicle, the promote, and so there's an economic situation here where if they don't get a deal done in a certain period of time, they'll lose that money. Those fees are all paid out of the IPO proceeds. So $10 a share in IPO, there's $10 sitting in trust. You got to pay all these expenses. So the sponsor puts up that money, which that risk capital, they're buying units or they're buying warrants, they're putting in real several $1 million, whatever the number is. And so the investor knows that now when that happens, the underwriters have said after expenses, there's still $10 sitting in trust. That trust account, usually managed by someone like a Morgan Stanley, a UBS, or wherever it may be, holds U.S. Treasury short-term T-bills. And I'm not an expert on fixed income, but T-bills are 1.5% per annum. Right now, income, and it's backed by the U.S. government. So if you bought a SPAC IPO, you're buying something that's backed by U.S. treasuries, okay? Short-term treasury bills. At the same time, typically these SPACs will come with a unit. It'll be a share and, historically, long-term period, warrant. So there's some type of warrant derivative opportunity. So the SPAC comes with a share and let's say half a warrant. The warrant is the right to buy a share of common stock at $11.50 a share for a period of 5 years. There's a forced exercise on the warrant if the stock's at $18 or $24 for 20 out of 30 days after a merger has occurred. And maybe you get half a warrant, a quarter of a warrant, or a full warrant as part of the unit. Typically after the IPO occurs, somewhere between 50 to 75 days later, after the shoe has been exercised or not, the warrant, the unit will be separated. So investors have the option of breaking apart the unit, and we have a share that's going to trade, we'll have a warrant that's going to trade, and we have the unit that still stays intact and is trading. The reason I break this down for you is the share is the only instrument that's backed by the trust, the T-bills, okay? Now, the SPAC charter, let's say typically over the past 10 years has been, let's say 24 months to find a merger target and close a deal. And if someone like me can't get a deal done in that 24-month period of time, I have to surrender, wave the white flag, and let all the investors redeem their money from trust. They will receive their $10 plus the interest earned over the last 2 years minus taxes. So they're going to get that short-term T-bill interest rate return. Okay, so when I say riskless, it's, do you believe the U.S. government, securities are riskless? And I believe yes. There's very low probability we default. At the same time, that's the share. The warrant for the last 2 years, typically when these warrants start trading on their own, the warrant will trade on its own based on the certain percentage of warrant coverage or who the management team is. Let's say Bill Ackman, I'm sorry to pick on him, he's a terrific guy, I'm sure, and super smart, but his warrant was trading the other day at like $7 or $8 or $9 before you could even, for the full warrant, before you even announced a target, right? So the investor that bought that IPO on Bill's Ackman SPAC was $20 backed with treasuries. Stock was at $24. So they made 20% on the money. He still hadn't announced a deal. And they had a warrant that was worth $8. So you made almost like 40, 50% on your money, and the guy hadn't found a deal. And at the same time, worst case scenario, that your downside is it owns US T-bills and you're going to get your $20 plus interest back. So it's a riskless product. What you've seen is these financial institutions, and I know with Archegos, things have changed. They were able, because their T-bills, to lever this up. Maybe sometimes they get 2 or 3 or 4 times the amount of leverage if you're a hedge fund in buying these SPAC transactions. So there's downside if the things move down on you when you use leverage, but for the normal investor, they are a riskless deal. When we break the unit, just for the layman, the average investor out there, the warrant, let's say a full warrant and a typical SPAC over the last 10 years, the warrant would immediately start trading at 30 to 40 cents. This is before we went into this bonanza Mitch was talking about. The stock, if you hold it through maturity, let's say someone bought a pizza business and you didn't like pizza, and you didn't want to stay in the deal, you could get your $10 back. The share would typically trade under $10. The unit, if you count it up, once you break them up, would be at 10.15, 10.30, 10.40, and you can do the math on where the warrant's trading, where the share's trading, and that's how you get the unit price. But typically the stock would trade below 10 because there's this time value. You've got to wait you have a 2-year period. And as you got closer to the 2-year period, the stock would start trading closer to 10 if a deal had not announced, because that redemption's coming up. But again, if you're buying the IPO, that unit, yes, it's a riskless transaction. And I'm sorry if I went off on a little tangent, but the one thing when you're a sponsor looking and forming the capital here for your SPAC is, number one, making sure you have the right amount of capital in your pocket to help go find that deal, and B, you got the right shareholders and investors that once you bring a target to the market, there are people that actually want to buy that business. So if we're going to buy a pizza chain, it's people that have interest in retail consumer, fast food, kind of businesses, not someone that's looking for a technology deal, right? So, but all in, while I'm looking for a deal, people are having a pretty nice thing to put in their portfolios.
Perfect. Thank you for that, John. Mitch, you talked a little bit about this in your sort of introduction there just a moment ago, but what do you see as some of the advantages and the disadvantages of SPACs versus, again, the traditional go public type transactions, right? IPOs, direct listings. And again, let's put this in the context of the public, the company that's going public itself.
Yeah. So, you're right. I mean, I started talking a little bit about, what were some of the advantages in choosing this back for the IPO. A couple other things. There are a lot of nuances I didn't go into, which I'll explain a few of them to you now. First of all, remember that the SPAC team is committed. So that's a difference between a SPAC and an IPO underwriter. IPO underwriter has no investment, no commitment in the deal. They extract the fee at the time of the offering. And that's their entire investment. If the deal happens, it doesn't happen, they're going to essentially go with market conditions. By contrast, the SPAC, you've got your counterparty, they have a substantial investment in the SPAC succeeding. So typically that could be like 4 or 5% of the amount of their SPAC that they're investing, into the deal. If that deal doesn't happen, if they can't complete a business combination during their term, they forfeit and they lose that investment. So you're now dealing with it's a very different negotiation. You're dealing with a counterparty that's got a lot of skin in the game, that's committed to getting a deal done. That's one advantage. Now, secondly, if you go beyond that one layer, what you're seeing in SPACs is that you're partnering up with someone that could actually maybe bring some additional value to you, that could help you as a company down the road. So let's look at the SPACs that John's done, for example, that he's done on Roth CH. If you're a target company and you look at one of these Roth CH SPACs, for example, you've got these guys they're fully committed, right? They've got stock in the merged entity. They're invested in these merged entity. And if you're one of those target companies that merges with one of their SPACs, for example, and this was true with the private equity funds, but it's true with like the Roth CH type SPAC, is that that you've got 2 investment banks behind you who is invested in this deal as a shareholder. And you sort of feel like, because a lot of operating companies that, everyone's speaking to different banks. You're just another client to one of these investment banks. Markets come and go, sectors come and go. There's a different flavor every day, every week or whatever. But that when you've combined with one of their SPACs, that these guys actually they're committed. They've got a significant amount of equity in there. They are committed to making sure that they can do whatever they can and use all of their resources possible to allow this company to succeed. And I think that's a very, 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 very important point for target companies, to know that they're just not going to just get an underwriter, just take them out and forget about them, that they actually have a committed partner in them. And it could be, a financial partner. It could be a banking partner. It could be sometimes a strategic partner. Sometimes you see operating companies that find SPACs that are sponsored by people who are like, major players in a particular industry, that they feel that those people can help them. So there's many different ways that partnership can help that target company. The other thing that I'll tell you is that you have more flexibility in doing a SPAC than you do with an IPO, in the sense that, you're not just pricing a deal. In an IPO, you price your deal on that pricing date. That's what the price is. It is what it is on that date. Take it or leave it. That's all you can do, right? You either postpone the deal, you kill the deal, or you take the deal. Those are your options. There's no other options. Very straightforward. But the SPAC, it's actually not that straight. It's more nuanced. You can price a deal, price your deal, but then you can include in your merger agreement all sorts of components which could increase your value over time with performance, could decrease the value of the value by retiring shares if there isn't performance, or increasing shares if there is performance. You can find all sorts of ways to accommodate valuation based on performance going forward, because you have a merger agreement that can be a living, breathing instrument that can encompass all of those permutations. So those are a couple of very, very significant advantages with a SPAC. Trying to be balanced and try to figure out, are there disadvantages with the SPAC compared to an IPO? And I think that what you do have to keep in mind, because I just want to just have to be fair about it. I do believe on balance the SPAC does offer a lot of benefits, but if there's disadvantage, you do have to take a look at your dilution as a factor there. That the SPAC has 20% of its shares owned by its promoters. There's all these warrants that are outstanding. So when you're going to go merge with a SPAC, you're going to have to manage dilution going forward. Is this the SPAC the right size for you? Is this enough? Is this an appropriate level of dilution for the type of deal that you're doing? That is something that you need to carefully look at. But another advantage to SPACs, which I just want to make sure before I stop this, is very important, is What we've seen over the last year is that you do have a pipe market. Now the pipe market could be more or less active at any given time. But what's a tremendous advantage for the SPAC is that when you announce your merger, you typically have, most SPACs have a committed pipe announced at that time. So as you're going into that deal that you have a commitment not only from your merger partner, but a commitment from some investors. Whereas with an IPO, you can go all the way through the process, get to the very end, and find out you don't have a deal. So there's, you have the dilution aspect with regard to the SPAC. That's absolutely true, but you have all these other advantages. I think as you've seen over the last year or two, as I spoke about earlier, I think on balance, more people have seen those advantages and have found ways to deal with those disadvantages. And that's why you're seeing this movement.
Robert, you had a couple questions for me. I'm going to merge the next two that you give me together, because they kind of just, not to interrupt you, just they're kind of one and the answer is like one and the same.
Yeah.
If you I think your question was, I've been a SPAC sponsor and I've been an underwriter on a SPAC, what's the difference? And then the next question is like, as a SPAC sponsor, how do you find your deal flow? And you got 24 months, I always use that, the crude saying, you got a gun to your head, you got to get the deal done. How do you find the deal? And is that a fair amount of time, 24 months? And so
right.
I put those two together, those two questions together, because, and again, we run a boutique investment bank, Craig-Hallum. It's our 30th year in business. We're 100 and something employee based, firm based out of Minneapolis, a few offices across the country. I don't claim to be, Credit Suisse, the number one activity, or city, the number one underwriter of SPACs. But, I've been in SPACs for a long time. And, as an underwriter of a deal, whether we IPO a company, do a follow-on, private placement, convertible, or a SPAC, we are providing a service to like Mitch, we are providing a service to a company or to a team. So a group of entrepreneurs that know a thing or two about a certain sector and say, look, we had $50 to $250 million in trust. We have great deal flow. We're going to be able to go do that transaction. They actually need a registered, FINRA member broker dealer to raise them the capital. And part of that process as well with these SPAC IPOs, it used to be 20 years ago, it was a smaller universe, and there were SPAC underwriters, right? And they'd underwrite a SPAC, and there were certain firms that would do it. But once you went and found that target company, that sponsor found that target company, they'd have to run around all over Wall Street trying to find institutions and mutual funds that could help them look at the business and write a check, either in a private placement or really just buy the stock, right? And then they'd have to scramble around and find a research analyst at this firm or that firm to write research on it once it had been de-SPACed and the merger had closed. So, the beautiful thing for full service investment banks like ours is we've got 25, 30 senior research analysts that cover, several different verticals. We focus on growth companies of different shapes and sizes in the growth economy. And so as an underwriter of a SPAC, the value add that you would be expecting when you hire an investment bank, whether it's Citi, Jefferies, ourselves, Cowen, whoever it may be, is not only do they have the underwriting capability and the relationships with the institutions, but that they would have the ability, if you went and found that, SaaS, tech, software business or big data company, whatever it is, they have a research analyst that covers the comps in that vertical, and they could help you with either the articulation of the story to Wall Street, writing research on it, or eventually, if there's a private placement or a pipe involved in the transaction, they would execute that for you, so you don't have to run all over the place. We have taken an approach, and it was a unique opportunity. So we've been doing that, and we have also fulfilled the role as sole, merger advisor or co-merger advisor, or sole buy-side advisor or sell-side advisor on the M&A of these transactions over the past, 5 or 10 years. And so we have seen, private equity firms come into our office and one said, hey, we want to IPO. And we want to IPO this business, but we want to cash out of a certain percent. And, we said, that's better for a SPAC. And so we ended up, that's how we ended up with Lazy Days, which is a leading RV dealership business in North America, merged with the SPAC. We were the M&A advisor. We also raised $95 million or $94 million in the private placement. And so we've been the banker on the buy side, the sell side, on the pipe, on the IPO. And the thought was, well, gee, we've done a little bit of everything. If we actually put up some capital here, and the next layer, which is really interesting, is we have a ton of deal flow. We're in the deal flow business. That's what an investment bank is. We have a deal flow machine. We've got 20, investment bankers. We have 1,000 amazing institutional customers in the US and in Canada that feed us ideas and deal flow. And so, we look at private companies on IPOing them, advising, companies in their M&A transactions, or private equity or venture capital firms. So the idea was, not only can we do the banking, but can we tap the natural resource of the deal flow that we have internally and with all the relationships at other banks and other, firms like Mitch's firm and accountants and all the deal flow sources that we have. So it's turned it into, instead of being an investment banker in a project, it's like the never-ending deal that you're working on. Usually these are 30 to 45-day projects for bankers. This is the one that's like, it's like Groundhog Day. You're doing it over and over. And it's worked out very successfully. I'd also say, whether you're, at an investment bank now, the deal flow has changed tremendously over the past 10 years and really over the past few years as this has become a more institutionally accepted product. There are more and more companies, as they're going through the process of going public, it's in the discussion in the boardroom now, should we IPO or should we SPAC? So that's opened up more opportunities for banks and sponsors for us. Finding that deal flow is very important, whether it's as a sponsor or as an investment bank, right? So it's not like I can sit here as the sponsor and an employee at an investment bank and assume, gee, I wake up, today and that deal is just going to fly through the phone at me. You really have to work that network and let people know that you have this SPAC and be aware of it. There are many successful serial SPAC issuers, whether they're people reference like a Harry Sloan who did DraftKings and Skills and William Scotsman. But people that have been doing this for a long time. He's a former, I think, CEO of MGM, and so the idea for him to do a SPAC, is someone, he is in a high-profile, powerful position. He's being shown deals all the time as an investor, as a former acquirer and aggregator of businesses in the growth sectors and technology and in media, and so he put together a team around him that has similar type of background. There's a partner, Jeff Sagansky, that has a similar background to them. So they get shown deals from a million different people. And that's the idea, that's the thought on why they did SPACs. And then relationship-wise, they have relationships with different investment banks and research analysts and institutional investors. And so when they have a deal, they have a network they can rely on to invest in that deal and help bring that deal to market, write research on it and bank it. So I'd say, today, the first few things, a lot of people, when you see people on Wall Street making money, a lot of people chase in that direction, right? So all of a sudden you saw a lot of people doing SPACs because a lot of people like Chamath started making a lot of money doing it. Virgin Galactic worked out, and Nikola and a couple other of these clean tech deals started working. So you see all these, electric vehicle businesses with revenue expectations in 2029, and all those, a lot of people jumping into that game. But, finding that deal flow before you have the SPAC, you got to put together a team that is going to be supportive, that's going to help you not only find the deal flow, but go through the diligence, go through the checklist of the 40 or 50 things to look for in a private company. Make sure the audit's ready, visit the facilities, talk to the customers, make sure that this is a sustainable, business. And then you got to have the team that's going to help you bring that deal to market, whether it's on the M&A and the banking side, et cetera. So here at Craig-Hallum and with our partner Roth Capital, we've got that covered because we have a great independent board. We also have a great team, which are bankers and partners of both firms, and then we have the support and services of both banks. But that's really the key is not waking up, doing a SPAC, and then saying, okay, we got to find deal flow. Let's figure out how we're going to get it, and hope and pray that in 2 years we'll get it done. The idea is that, hey, we're in the deal making business. We have no agreements with any companies at the current time being before we do an IPO of a SPAC. That's part of the rule. But we should know that we're in the deal flow business, and we see different stock ideas and opportunities all the time, and we're going to tap into that for our transaction.
No, I appreciate that, John. And I think, you touched on a couple of questions I had, so I'll sort of jump just a bit here, and maybe Mitch, let's turn it over to you. There's obviously been a great deal of controversy, and John sort of has touched on this a little bit regarding the due diligence that's conducted between traditional IPOs versus SPACs. From your side of things, walk us through some of those differences, and is that point valid? And John, if you want to jump in there as well, please go ahead.
So I don't subscribe to that theory, right? And to that criticism. I see where people say that, and I'll highlight that, but I really don't think at the end of the day that's true. I think that criticism has come from the fact that people automatically assume if there's an underwritten deal, like in a traditional IPO, that the underwriter is absolutely tasked with, because they have underwriter liability, and they have underwriters counsel, that they're tasked with due diligencing a company that their client as they go public. But when you actually look at the SPAC, so people might feel like, okay, so now the SPAC sponsors, are they doing the same level of due diligence on a target company as an underwriter is? I mean, I think that's sort of the question. And then what people say is, well, but these SPAC sponsors, they're so incentivized because of all of that equity that they have. They're incentivized. They have all this incentives. Are they actually aligned with retail shareholders? So the criticism is like, you've got all these retail people buying on Robinhood, 100 shares, 200 shares at the time of the merger announcement, and yet the SPAC sponsors have bought in at a much lower cost basis, and so they don't have the incentive to actually do that level of due diligence. They have all this equity at stake, and also that they have a limited time period, so they have to get a deal done, or they lose it. So the criticism is that maybe in that context there's less due diligence being done by the SPAC sponsors than by the underwriters. So that's sort of where that criticism comes from, and I understand the initial thought behind that criticism. But I think if you think about it a little bit more, the truth is that the IPO underwriter is also incentivized to get a deal done if they can get a deal done, right? In other words, if the market is there, they are very incentivized to get a deal done. So it's not like they don't have incentive. They have incentive. And to go further, they typically don't have equity in the deal going forward, whereas the SPAC sponsors actually, they can't disassociate themselves with this deal so easily. Like the underwriter, you go price a deal, and then something happens with this company 6 months, a year and a half later, they were out of the deal at the time of the pricing, and that was it. They took their cash commission and they were out of it. I'm not suggesting in any way, shape, or form, please don't take what I'm saying so far as to believe that underwriters don't take some, at least the good ones don't care. They care, but we're talking about comparing incentives. The SPAC sponsor, at the end of the day, they are going to be shareholders. They could have a board seat going forward. I don't care how active a sponsor you are. You could have done, but how many SPACs have you done? If you're a serial SPACer, you've done 5, 6, 7, 8 SPACs. Compare that to how many underwritings a typical bank does in a given year, how many deals that they do. So what I'm trying to tell you is that deal that sponsor does, it's going to be 1 out of 2, 3, or 4 deals that they do. They are so closely associated with that particular deal. That is a complete representation of them and their track record. So they're very incentivized reputationally to do that level of diligence. The next part of your question, you didn't use this word, but it's very tied into the due diligence, which is the transparency, because I think that they go hand in hand. People talk about due diligence and transparency. And this is a criticism of SPACs I'll never understand, and I completely vehemently disagree with, which is to say that the SPACs have potentially less transparency than an underwritten IPO. I've heard this one before for the last 20 years. Every time I hear that, I say, whoever says that has no idea what a SPAC is or how it works, they have no clue. So the situation is that what transparency do you have? In an IPO, you have a prospectus, right? In what we call now the de-SPAC transaction, which is the merger with the SPAC, you have a merger proxy or an S4. Anyone that makes this statement should take a look at just one prospectus side by side with the merger proxy and S4 and look at them and and determine whether you really think that there's any less disclosure whatsoever in that merger proxy or S4 than in an IPO S1. And there isn't anything that is in the prospectus that is not in that proxy or the S4. All that disclosure is there, but then I would argue to you there's actually even more disclosure in that S4, the proxy. And you might be like, well, what else is there? Well, typically SPACs will have an additional year of financial statements that the IPO doesn't have. And typically the proxy will actually make you disclose, there's a section, which is how the board got comfortable with this particular transaction and its pricing. Who's doing that for an IPO? There's none of that disclosure that's going into an IPO prospectus. There's no section that talks about, how that was arrived. Now, there might be certain closed door discussions in a roadshow, for example. That's possible, okay, but not in the actual disclosure the SEC or the SEC documents or the written documents that are provided to people. So I think that there's even more transparency in the SPAC process on the due diligence. Again, I think looking into it a little bit further, I do believe there's plenty of incentive on both sides to diligence the deal properly. And I do believe that for the most part, that SPACs, good SPAC teams are actually, diligent in making sure that, when they go into it. There's one other thing in the SPAC process. Remember, there's also pipe investors that come into at the time of the deal. They do their due diligence too. So it's not just the SPAC management team that does due diligence. You also have pipe investors that are doing diligence at the time that they invest. So I think you've got plenty of diligence in these deals.
All right, no, I appreciate it. John, I'll give you, is there anything you want to add? Otherwise, we'll wrap up with a couple of questions.
No, I mean, look, as Mitch said, I don't get the comment on the lack of transparency. I mean, not only do they want to know about the business you're buying, but how did you meet them? What are all the other businesses you looked at? How did you find them? All that type of deal flow. So I think that's kind of in line with what Mitch said.
Okay, here, and just maybe a couple of last comments here. John, you brought this up just a moment ago, talking about forward-looking guidance that companies are providing, pre-SPAC and the changes that some have had post-SPAC. What's sort of your view on it? And then maybe Mitch, as a follow-up to that, what changes do you think the SEC, if any, might be coming down in the coming weeks or months ahead relating to the topic? So John, I'll let you start with the first part.
Yeah. So this is a funny thing, and this is what you're reading about in the Wall Street Journal is, okay, these businesses that were giving projections, rosy projections in 2026, and who knows what's going on in 2026? Are we going to be alive then? We're going to be invaded by aliens. I see UFO stuff on CNN. So, that's the argument, is like no one has a crystal ball. There are companies that are VC backed or just high growth companies that jumped in because Virgin Galactic figured out that, okay, space travel, how many people are going to pay for it? How much are we going to charge? And when will we have our first, commercial launch? And we can sell based off of a discounted cash flow off of like 20 something numbers, and the same with Nikola. And so that's all of a sudden the VCs and the growth crowd of these growth companies said, wait, this is a lot better than an IPO. We're always just telling them what our target market is and what we did last year. We're not telling them what we think we'll do next year. So there is a more disclosure of sounding board but it also could be an opportunity for someone to, say something that's a little bit more rosy than, what is going to be reality. And it's a projection, which projections are not reality. They're expectations that either will be, achieved or not. So that's something that, comes into play. There are smarter people out there. I can't figure it out, electric, not bashing anybody's SPAC, but you got electric helicopters and flying saucer, businesses that are going to deliver your food via, drones, like that are going to have revenue and EBITDA in 2027. There are smarter people that can understand if the technology works, if the customer base is there, and it's going to actually succeed. I am not that person. I'd like to know, there's some tangible evidence today that the business is generating a profit or has an ability to be self-sustaining or self-supporting. And there's a deep diligence dive on that business, right? So projections have been used for a lot of SPACs in the last year and change. And look, we have an investment bank. Wall Street has always been focused on tomorrow, not today. It doesn't matter what you did last quarter. I mean, you know that in your IR business, everyone's looking 1 quarter, six months. And in some cases for these higher growth businesses that have been sustainable, these Amazon type businesses, they're not looking at what Amazon's doing next quarter. They're forecasting, okay, 2022, 2023 revenues, right? And so you do have Wall Street trading based off of a year or 2 years, multiple out. So that is a standard. So I think there's some there's some abuse of certain things potentially, right? Forecasts, or maybe the expectations are not going to be met, and that's disclosed. And there is a disclosure letter in that SPAC, I'm sure, that says these projections may or may not be achieved. That's also in the research reports by Wall Street. That's also when companies put out their projections and guidance in their quarterly and annual reports, that the guidance they're giving for this year or next year might not be achieved. But as a SPAC sponsor and banker, I find it very difficult for a business, let's say, that is a startup, to have a projection what they're going to do in 2028, and we haven't had a commercial launch of the product yet. I find that very difficult. It's played a key role in a lot of these VC-backed businesses getting really good valuations. But I do have to say the one thing to throw a little wrench into the middle, Wall Street has always done IPOs for these VC-backed businesses and tech companies. And, how many times have you seen an IPO occur at $20 or $30, and there's some choice accounts that get that IPO and it opens up at $80? And why did it go to $80 and it stays there? They sold it too cheap. Their hands are tied in telling people where they really think the business is going to be. The IPO syndicate is pricing it to get their customers in at a certain price. This is the price of admission, and then it pops. The retail crowd doesn't get the ability to buy into that IPO, only certain choice accounts. So these are all factors that play into those projections, and it does give that CEO a very sound, audience to tell, hey, we've raised $300 million over the past few years. We've got this business. This is where we're going. Now and full disclosure. So I think it will be here for good if diligence on those numbers. Look, we do the diligence on this stuff. Someone's going to do a discounted cash flow model and break down the numbers, how they get there. I'm not sure what the SEC will do with it, but I don't see there is much that they can do.
Yeah. Mitch, anything, I guess as it relates to the SEC from a legal perspective, is there anything that you see possibly being addressed or coming up in the future as it relates to, what John just referred to, or really anything else within the process here? And just a couple of minutes left here.
Yeah, no, look, I mean, we've, people may have read that there have been congressional hearings talking about maybe changing legislation here for SPACs. They focus on a couple of factors, protection for the retail investors, which is a lot of, the plus and minus is that there's more access to retail investors here. But as I said, that there's concern as to, is there a misalignment of interest? Are retail investors being are protected properly here? I don't see anything, bad with that discussion. I mean, I think it's to be expected that, having having SPACs hit this kind of, this is a product now that's like 70% of all capital markets transactions. There's going to be a lot of retail people over time that are going to start buying these stocks, through however they buy them online. So, that's a healthy discussion as to how to be more protective for those, for those people, right? I mean, that's not a problem with the structure. It's like, how could what are the things that people aren't thinking about where you'd want to make sure that retail investors could be protected? I'm not sure exactly what you could do about it, because even if you buy stock in an IPO or right after the IPO is done the next day, assuming you don't get the allocation that John's talking about, it still can go down on you. There's always risk when you're talking about equity. The other thing is the projections. That's a big thing. That is a big thing. That's probably the biggest thing that I think that you're seeing a lot of conversation about. Because in the IPO, as I said, you don't have projections in your prospectus. And here you've got, projections in the proxy statement. And the SEC has made it very, very clear that when these business operators include projections that they don't feel is being done on a reasonable basis, and essentially gaming the system to essentially just doctor up numbers to get lofty valuations, they're going to take a look at that from an enforcement perspective. So there's a safe harbor there. There's a safe harbor for projections. So if those projections are being made on a reasonable basis, there's a safe harbor. But if management teams are including projections that are not based on a reasonable basis, but are made with an intent to defraud the markets, that's something that the SEC is going to take a look at from an enforcement perspective. And frankly, they should, right? I mean, I don't see anything wrong with it. The question is now when it comes down to the safe harbor itself, then the question comes up is, should the safe harbor even exist for SPACs? And that's something that, Congress is going to have its own perspective on. The SEC is going to have its own perspective. I have my own perspective. Unfortunately, I don't have a vote in Congress, or, I won't be able to completely influence the SEC on this, except express my views to people who I speak to. But I think that that safe harbor, I believe, my personal belief is that the fact that you disclose projections is a good thing. You're providing more information. You just got to make sure that it's regulated, that it's scrutinized, that it's being done properly, that there's enforcement when people are taking this too far. But look at what really happens on the IPO. I mean, John was talking about some of the practical realities of what happens with allocations and so forth, but let's talk about what really happens with projections. I've been doing IPOs my entire career. I tell the clients, you can't put the projections in the prospectus. The underwriter won't want it. You're not going to include it in there. Well, what about the roadshow? Well, you can't put anything in writing. You can't leave anything behind. But whatever happens in the room happens in the room. That's basically what the whole business has been about projections for all these years, right? There's a verbal discussion about projections, but there's no projections that are actually, distributed that investors can walk out the door with, because nobody wants to get sued on those projections when they don't meet those projections. But there has to be some sort of a conversation that goes on in the room with regard to, forward-looking information. What regulation is there over that, right? Who's looking at that? Is the SEC looking at it? I mean, instead of saying we'll eliminate the safe harbor and get rid of projections in the proxy statement, I wonder whether the conversation should be about, no, listen, that's a part of life. Projections are a part of life in analyzing how you can invest in a company going forward. The question is, how do we do it? Maybe we can make it better. Let's not be less transparent. Let's be transparent, but let's regulate this properly. Let's make sure that people are doing this on a reasonable basis. Let's make sure that they're staying within the guidelines, and they're doing it properly. That seems to me to be the answer. But there is definitely going to be an effort to try to make the playing field level between SPACs or IPOs, so that one doesn't have an advantage over the other.
Right. Well, and I know we're getting really tight on time here. John, maybe just any final takeaways, and for anyone that wants to get in touch with you, any information you can provide. And Mitch, I'll same thing after John's complete.
Yeah, you take a look at our website, www.craig-Hallum, and you'll find my contact information there, or one of the wonderful people that we have here. I'd say, as Mitch just said, this SPAC's been around since the early 90s. The product's going to be around in some shape or form, I assume, for the next 20 or 30 years. Maybe there's some restrictions and things that are put on. I'll leave it to more of the thought leaders like Mitch and other lawyers and advisors on how that works out with the SEC. But at the end of the day, if you can come up with an elegant way from this private company to get public without having to spend several $1 million in 12 months and then figuring out if the IPO is going to happen, if you can, with a SPAC in a couple month period of time, 6-month period of time, and with a PIPE, give them a guaranteed financing and a path to the public markets through a merger, people are going to do that. A lot of them are going to do that. Now, the question is, when you look at SPACs, the $1 billion SPACs, the $50 million SPACs, or the SPACs in between, it really relates on the size of the company versus the size of the SPAC. And what's the incremental dilution versus an IPO is really the argument you should be having in the boardroom. And I think that's a very compelling, the right size SPAC versus your business. That's going to be a very hard thing to just say, great, let's spend the money and do the IPO if we've got a good sponsor team and good investors and shareholders do it. On the individual investor side, you got a lot of upside. The institutional investor, a lot of upside in SPACs. You have this optionality with the ability to redeem. For the individuals that are out there playing these transactions, they're very difficult. You got to really follow it. You got to use an advisor or really do a lot of research and make sure what you're doing. I think there needs to be controls and a lot of investor and retail education with amazing apps like Robinhood. There are a lot of people, on Reddit following stocks and they really don't understand or have not read the full proxy. There's a lot of, the warrant, there's a lot of ways to make money in SPACs, but again, I'm a Jim Cramer bull, diligence, as you're investing and be careful and do not invest anything that you're not willing to lose, right? But I think it's a very unique product and we still have a ton of really good companies that are coming public over the next year or two of this in this process, even with a slowdown in it. So I appreciate you having us join.
Absolutely. Mitch?
No, just in closing, I agree with everything that's, that John said. I think that, it's interesting. I've been doing SPACs for over 20 years. The first 5 years I was doing them, a lot of this stuff was coming up, all the questions that you're asking me. Is the diligence there? The SEC, for example, was very, very skeptical of the SPAC because it was sort of like a stepson of the blank check offerings, which were certainly under some degree of scrutiny. When the exchanges got involved with SPACs, you could understand that they were very concerned reputationally about taking them on. So there was all of these questions came up about 15 to 20 years ago with SPACs. And what's happened now in the last year is that SPACs have really have hit the mainstream in terms of, in the media with people all over the capital markets business, just business generally. Everywhere you go last year, starting for the first time, everybody knows about SPACs. And the conversations I have with people just that I would think have no understanding about any of this stuff because they're so far away from this business that they actually have heard or know about SPACs. It's astounding how widespread it's been. So it's not, I suppose, it's normal for a lot of these questions to be asked about, right? It's hit a certain scale where it's really put pressure on the regulators, the Congress, the media. I should actually say it starts with the media always, and then it goes down to the regulators and then to Congress. That's actually the pecking order. But that's what we're going through. We've been through all of this before. Here's the thing. I've never seen money disappear from a trust account in the SPAC business, like all the billions of dollars that are raised in the trust account. I've never seen money disappear from that. I've never seen nasty class action lawsuits during the period of time until they complete their business combination. What I have seen is after the business combination, I see a variety of different outcomes. I've seen some companies do extraordinarily well. I've seen some companies do okay. I've seen some companies not do well. And that's not different than, frankly, if you go to, you see regular IPOs where you look at them 9 months, 12 months, 2 years after the IPO, and then you start tracking how they do compared to how SPACs do. And the reality, it always comes down to this. We could sit here, talk about SPACs, IPOs, we could talk about structure. All it is Let's talk about the business. Let's talk about the company. Let's talk about how they perform. Are they selling their goods? Are they working? Are they getting FDA approval? I mean, what are they doing? Nobody talks about the businesses. They love talking about the SPACs, the structures, and all of this stuff. But let's talk about the business, because I can promise you, if the business does well, it isn't going to matter whether this thing's been a SPAC or an IPO. Eventually, it's going to trade on its own merits, right? It's going to do what it's going to do. This is just a question of which road do you take. You know, you look at your navigation. It's got route A, route B, right? You know you're going to end up wherever you're going to end up. It's just a question of, are you going to go down route A or route B? And that's what this conversation is really about.
I think that is a great way to conclude this. This has been a very informative discussion. I hope everyone else listening here thought the same. So, gentlemen, thank you very much for your time. We greatly appreciate it.
Thank you. Thanks for having us.
Thanks, guys.
Thanks. Bye now.
Bye-bye.